Hey guys, what's up? Stock Retail coming back to you. Boy, it has been a little bit of time. Had a family vacation, and then if you followed me on Twitter, you probably saw I caught one heck of a chest virus that effectively basically turned into pneumonia. Um, just took the family to Disney, caught a bug there, but pushed real hard, and then I think just paid for it when we got home. So I am fine, but between work, vacation, and illness, that's just why I haven't been making any videos. In fact, I'll have to beg forgiveness. I may have to clear my throat a few times here more than usual. Um, but I wanted to talk about something that I just saw on. I had posted on Twitter about it just like an hour ago, and then did some digging, some DD, and I thought, you know what? I'm not going to try to do some nice polished deal that I often do for you guys. I'm just going to go ahead and share what I saw real quick, and so we'll make this maybe a shorter and sort of less polished type of video. And you can see just the highlight. Did AMC pay down $400 million in debt? What I want to just show you, so you know that, actually, before I go there, so you know a few weeks ago, um, Adam had announced that we had a deal with Marathon. And the Marathon guy, by the way, has been tweeting a bit. He actually tweeted some fairly pro AMC tweets. And if you don't know, he's kind of in the hedge fund circles. So it's interesting to see now someone in high finance, someone in the hedge fund circles, tweeting positive comments about AMC. So that's been kind of interesting to see, and perhaps signaling that crowd like it's time AMC has kind of completed. It remember survive then thrive, right? So in a way, this was probably the end of survive. That's my point of view. Adam pushed out the date of all the debt maturities, especially that 2026 debt. It's now in 2029 and 2030, which I had said for months was coming. So that kind of matched, made a lot of sense to me. So I went ahead finally and read the filing that we did, which shows how that refinance happened. So I'm going to walk you through that real quick, and I'm going to tell you why today I've kind of felt like perhaps we just had some debt pay down. So let me show you kind of what triggered this thought today. Let's just make this bigger. Okay, so you can see that I spotted what I was actually doing is I was just going to finally go read this filing. I had started a couple times and was just too exhausted from this sickness and never got never got through it. And then as I went to AMC's investor relations site, which I always recommend going to the SEC site or to AMC's site, so you can see, we have. You can see there's a filing that's 849 pages. That's the big debt refinance filing. But I noticed today that there was another filing, and it was basically a statement of beneficial ownership. So you can see that's this here, a 13G. You might have seen those when people post like Fentel screenshots that show some different ownership of institutions, who has calls and puts and shares and all that stuff. Those are 13G filings. So I was like, what the heck is that? And so then that led me, these are just some screenshots from this. And I'll admit, at first I was a little bit triggered because when Ape was coming out, if you might remember, I even have a video on this. You can go find this. Millennium Management, who is, the video is crazy because it connects Millennium, the mob, yes, I mean literally the mafia, Kramer, Madoff, and a whole bunch of stuff. And so it was really crazy that Millennium was buying shares. But what happens is sometimes their entities will spread out their buy across multiple legal entities. So watch this. So you can see here was Discovery Capital Management that bought about 24 million shares. I think it was 6 point something percent ownership. But then you also had this Robert Citrone, which also was kind of like, that's like fingers on a chalkboard. Obviously, we're seeing everything going on with Andrew Left and all of that, and Citron. So just funny to see now some dude named Citrone, and also RK. That's, we live in a sim or something, guys. I don't know. But so this Robert Citrone, he's over Discovery Capital Management. And so you can see an identical purchase. So if Discovery Capital Management bought this 24.5 million shares, so did Citrone. And then Discovery Global Opportunity Master Fund, so another legal entity, this one in the Cayman Islands. So if you go back, you can see Citrone is a citizen of the U.S., and then the LLC is in Connecticut. But then there was one entity that's registered in the Caymans that then bought 22.3 basically million shares. So the total, I'll just kind of show you that too. The total across those guys was this 71 million shares. So you can see, because I just wanted to make sense of this. So I started trying to type this all out for myself. So you got the two 24.5 million share buys, the 122.2 all adds up to 71 million. Ignore the bottom right. I'm going to get back to that. So then I went and read the refinancing filing. So the actual refinancing filing is about 9 pages here, but then notice how these are all links at the bottom. So one of the things I wanted to go look at was about, you're going to see something about exchange rates, and we're going to talk about that. Because what we had, I kind of just made some notes. So these are going to be like almost like napkin notes I took. I didn't take time to put this in a presentation for you, but I'm going to walk you through this. So first of all, AMC worked, I'm just literally going to go through my notes as I read this. This is the stuff that stood out to me. So AMC actually worked with 2 creditors. Marathon is the one we all kind of noticed because he started tweeting and all that. So I'll have to do a little digging and find out who the other one was. I told you already that we basically took 2026 debt and we moved it to 2029 and 2030. Let me skip down a little bit. I'm going to explain one thing that you might have seen in Adam's tweets or in the filing. There was this creation of this Movie Co. LLC. So I have a little bit of experience with LLCs. It's a limited liability corporation. Some people might call it a limited liability company. It's think of it like a company with a force field around it, and whoever owns that company, that what's inside that company. So think that word liability. Liability is when you're on the hook for something. Everything inside that company, like say you went bankrupt or whatever, or like I had family who had a rental property in an LLC, and like say someone slipped at the property and sued you. Well, the family would be protected. Only the LLC would be on the hook for damages. That's why it's a limited liability corporation. That's that force field around it that I was explaining. Like anything that happens to the LLC only happens to the LLC. It doesn't happen to its owners. So what happened was AMC, and I think I've got this down here somewhere. Here we go, this row. Transferred, let me make this bigger for you guys in case you're on small screens. Transferred certain leases, property, and assets and rights for 175 theaters plus some intellectual property, including the AMC brand name. So they took basically everything around 175 of our properties, put that in the Movie Co. LLC, and then they got these new loans against it. So it just means everything else that AMC owns, I suspect like maybe Odeon properties and some other stuff, is not at risk, basically. These loans are against just what's inside of that Movie Co. LLC. So that's all that meant. And then you can see Movie Co. basically has these management services agreements. So it still means effectively your AMC leadership team manages Movie Co. Movie Co. is just part of AMC. That's all that means. But there's this like force field around these 175 properties and the assets and the AMC brand name and stuff. Only that stuff is at risk. There's some other stuff in the company that wouldn't be at risk. That's all that meant. And I'm not worried about that. We've kind of established we're not going bankrupt. So that's really, the only case where you'd kind of even wonder what's going on there. I'm not worried about that. Okay, so let's get to the meat of all this. Pardon me. You would see in the filing that there were new term loans. So term loans just like based on a term of time with a given interest rate. And those were 1.2 billion. But then later in the filing, you also see that really it's like 1.229. So I'm going to kind of use that number. And there's language in the filing about what the interest rate is. So let's kind of see that. It says a base rate plus you get some basis points. It kind of is just finance speak. Or there's a kind of a rate that's used by a lot of banks and companies. And it's that plus some basis points. So it kind of depends. It can kind of go back and forth on what's going on in the world of finance and interest rates and all that stuff and the Fed. But basically there's a set interest rate for that. And we'll get to that. Okay, so then, because they made this new debt, so you can see I've just kind of made myself 2 columns. What got paid off and what's new. So they made this new debt, but they used that really, because notice that's kind of 1.2 billion, and here this is 1.2 billion. So they paid off some of the 2026 first lien, and then they paid off some of the 2026 second lien. There's just different debt in 2026. So that's something I've tracked for a long time too, and I've even shown you guys in 1 or 2 videos what the debt is. I think a video last November I might have spelled out all the different debt, and I might even just show you that in a minute. Here, why don't we even I'll just go to that. So this is old. You can't take these numbers really. These are a little bit outdated, but this was something I was tracking and just hadn't updated for a minute here. But you can see like that 2026 debt. So we had this 1.9 billion on what's called a senior secured credit facility term loan, and then we had this about 800 million, which is kind of referenced in the refinance filing too, that they were maybe going to pay off about 800 million. And this is a second lien. And you notice this has kind of higher interest rates on it. So I've been tracking all of these, and what's our total debt, and what's our total like blended interest rate, and how much does that cost us in payments per year and payments per quarter. This is pretty old. Like I said, we're not paying quite this much a quarter, like in the recent filing, for example. But you get the idea. So we had this 2026 debt. We got a little bit of other debt kind of from 2025 and 2026, but he's working on paying that off too. So basically we moved 1.2 billion. Like all these just tie. Take 1.2 billion in 2026, move it to 2029 and 2030. Here's where it kind of gets interesting, and I'm going to come back to my Twitter post. We had about 400 million, you can see, that we put on exchangeable notes. Exchangeable means you can exchange it for something, right? You can trade it for something. Or sometimes you might hear of like convertible bonds, so it's not too different from that. And basically these can be exchanged for shares. And so I think that may be what happened. And so like I said, at first, let me come back to that Twitter post. Where are we? At first I was like, oh geez, here we go. This looks a lot like Millennium. I don't love this. I got the Cayman Islands. We got multiple legal entities. It's a way they try to stay under certain SEC reporting rules in terms of how much of a percent of a company you own. So you'll notice like each of these entities only owned like 6%. They all stayed below kind of a reporting threshold. If you had combined them, then it's closer to 18%. And if someone bought that much, there's just a lot more visibility into what they're doing. And so remember that was these 71 million shares. Now, if you go through the rest of that refinance filing, and it has some language about how the exchange can happen, how these guys, these debtors, can take their $414 million of debt, that, by the way, we used to pay off some of that 2026 debt, and move it again to 2029 and 2030. So there's a way these debtors can trade that. Maybe they say, I don't want to hold AMC's debt, I'd rather hold AMC shares. So they can trade that. Now, I'll just tell you right off the bat, that does mean dilution. That's fair to talk about. But you also know my view, if you've watched me a while, that there's something called value creation. Because what happens is, if they flip this into debt, if they flip this into shares, they're doing that at a price, which is paying off debt. So they're actually paying off the debt that they own. They're forgiving it and trading it for shares. They're saying, I'd rather have shares instead of debt. AMC, I'll let go of your debt. You don't owe me anymore. Just give me the shares. And so it's a way of paying off debt. And if you look at the filing, what happened was AMC basically did a 13% premium over the share price. So it was, I think the share price at the closing of this filing was like 501. And then they said, all right, if people want to exchange for shares, they have to do it at 13% above that, which was 566. And the filing from, I'm doing a little bit of speculation and dot connection here. I can't necessarily yet prove this. Maybe Adam will talk about it in the earnings call tomorrow. I don't know. But if you notice, the filing from Discovery was on the same day that AMC, pardon me, came out with the refinance. So same day kind of tells me, I think these are connected. And then the numbers are just awfully close, because you see we issued that 414 million of exchangeable debt. And if I use that 566 number, then Millennium shares come out to about 400 million. So what I'm telling you is, I think that possibly, I said Millennium, I meant Discovery, sorry, just still, I don't know, I twitch PTSD from what Millennium did to us. Seriously, go check out that video sometime. It talks about the mob, Kramer, Madoff. It's a whole bunch of stuff. It's crazy. Millennium was no bueno, in my opinion. But perhaps Discovery here has exchanged their debt for $400 million of shares. Now, what I want you to hear too is, if we use, so if we're paying off, let me go back. If we're paying off that second lien from 2026, that 800 million basically, you notice it's a 10%, 12% cash / payment in kind, toggle, second lien, subordinated note. That's a mouthful. So I've tended to just go between that 10 and 12, and I don't know the full mechanics. I haven't read that entire, the documentation on those notes. So I tend to use 11% for those. And so, if you want to use the lower number, 10%, if you want to go higher, 12, but I'm just going to use the 11. So those were effectively costing us almost $90 million a year. So if you use 11% and you take that $400 million, if I'm right, if Discovery has traded $400 million of debt into shares at 11%, let me multiply this one by 4 and I'll explain that. At 11%, that's over $44 million a year of debt payments we no longer have to pay. So what you would see, that goes straight to the bottom line, guys. Remember you hear like EBITDA, well, but the I in that is interest. And so then after the EBITDA, you have something called net income. And so that's the real bottom line earnings when you see like earnings per share and all that stuff. So the interest is included there. And if you lower your interest payments, two things are happening. One is you're keeping more cash in your hands. This is actually going to improve cash flow. This is a cash expense. So that's one. It will improve your cash flow. And then the other is it will improve your earnings by this amount. That bottom line, that earnings per share. I like to look at earnings rather than earnings per share, something called net income. However you want to look at that. $44 million a year, if I'm right, that AMC now has versus what we were just a few weeks ago. So that's not small. And then you see what I'm showing you per quarter. That's $11 million a quarter. Remember how great Q3 was last year. Our bottom line was about $12 million of positive earnings. This would basically have doubled that. So just think about that. This alone would have doubled Q3's earnings last year. We would have, instead of 12 million, we would have been at 23 million in positive earnings. And all that $11 million would be cash sitting on AMC's side you don't have to burn that on interest payments. So that's why I'm a little bit excited about this. I've told you in the past, I think you're going to see a time when AMC is going to be valued at anywhere between 15 and 25. I just like to give you a conservative and a more aggressive number, 15 and 25 years of earnings. So if you did that, what you'd want to do is you take this yearly number, let's just split the difference and call it 20 years. You'd have to add almost $1 billion of market cap into AMC. So if you know what market cap is, so just take this number and divide by all the shares. I think Webull right now is showing 360 million shares. Divided by 361. 123. That would add $2 per share. Now, the thing is, I got to show you the dilution amount too. So you'd want to, I've done that in other videos. Maybe I'll do that later. I'm not going to do that now because this was kind of, like I said, less prepped, just throwing something together for you. But so you'd want to, you're not going to see all of that money go into the stock. There's sort of a dilution that drives it down, and then this value creation, I've called it, that drives it back up. But the point is, let's just focus on, let's call it $10 million plus a quarter, that in the future, like say when AMC comes around to reporting Q3 in November, you would see that as more savings on our interest payments. So really good news if it's true, but I just want to remind you, I'm kind of speculating here. So a few bottom lines. Let's just go back to here. Hadn't talked to you, well, first of all, just hadn't talked to you in a while. There's still a lot of other stuff to talk about. But I'm going to cut this one short because it's late East Coast and it's getting even late over here West Coast. But AMC refinanced the debt, has this 4 to 5 year runway to pay off that what's now 2029 and 2030 debt. AMC has flipped profitable. If you've seen my tweets at all, or just if you're tracking the box office, you know that June was almost $1 billion. July was well over 1.1 billion. Between the two, that's a $2 billion, domestic box office in just 2 months. There have been plenty of whole quarters we didn't have 2 billion. So that is how hot the box office is right now. And you've heard me say that, through the rest of the year, Adam has said through the rest of the year, we're looking much better. So that matches forecasts and predictions. We are in the much better zone. And what I keep reminding you is then 2025 is even bigger than what you're seeing now. If you think now is fun with Deadpool and Inside Out and Despicable Me and Twisters, and now Trap is coming out tonight and just on and on. If you think now is fun, 2025 is even bigger and far more profits for AMC. And then 2026 is even bigger than that. And so we are to the part where I think almost every quarter you're going to see positive earnings. You're going to see positive cash flow. We are into the Thrive zone, and Adam did the last piece, which was refinancing the debt so that we have time. This play was always about time. Shorts wanted us to go bankrupt. We all knew it was never going to happen. Adam's been making it move after move after move to make sure we don't. But what's great is not only has he been buying the time, he's been improving the profitability of the company. And you're about to see that. So I'll do another video sometime showing kind of the, I don't know, the levers of this company, the levers of profitability, and how we're going to be actually far more profitable now than we were pre-COVID. AMC is in a very strong position as the box office recovers. And you saw even now we've got the Usher concert movie coming out. There's just so much to celebrate. I posted today basically that the only thing holding us back is effectively the algos are trading, and you know people are controlling those algos. They're trading as though we're in a period of our history that's about 2 years ago. They're trading in a reality that actually doesn't even exist. So the algos are living in the past, and I've been trying to help you apes live in the present and the future, because AMC is already profitable. You just don't see it fully yet because we don't report these earnings until November. Like, we're not reporting Q3 earnings until November. But I do anticipate Adam probably will talk a bit about June tomorrow, because it's almost not even, I almost don't want to tell you I believe. I almost want to say I can prove, but I just want to stop short of that. But I can practically prove that June was profitable. If you just took June as 1 month out of Q2 that we just reported, I believe June was positive cash flows and was profits. It's just that's not the way quarterly earnings are reported. So looking forward to hearing from Adam and the team tomorrow. Just celebrate, guys. I know the stock price doesn't show it, but I'm telling you, your business is profitable, and by any metric, it is deeply, deeply undervalued, and we will win. So let's go.